Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project. I'm your host, Duke Ong with Tri-City Equity Group. For this episode of the educational series, we'll be talking about markets and geoarbitrage. With me is my co-host, Vince Gittings.
Hey, Duke. Excited for this installment of the education series that we're doing here. This is a pretty awesome topic, and I'm really excited about it because it's one of the things that we do, and I think we do it fairly well, is geoarbitrage. So let's get right into it. We all know the real estate, slogan, location, location, location. So let's talk about that a little bit. Like, what makes the location? What are the terms?
All right. So as far as location, some questions to consider would be, where is the asset located, and not just the market, but particularly within that market, where is it in the sub-market? This is because real estate is hyper-local. And the specifics of the micro neighborhood that the asset is located in really matters. So a few questions to consider here are, what is the median household income? Is there any new construction in the area? What are the vacancy and rent growth rates for this market? And what are the job and population growth numbers? So you can find these in various sites like city data, and that will help you kind of determine whether or not this particular sub-market makes sense.
Exactly. And to that point of being hyper-local, and this is something that's a lot of people overlook, especially when they're new to market research. They'll look at like an MSA or a broad area around, say, a major city. I don't know, pick one like Dallas or something like that. And then they forget that when the metrics they are looking at are skewed, because they need to niche down into the specific neighborhood, almost like the street, and look at the data around that micro neighborhood. Because you can have a place where and we've seen it in our own research, where the median household income might be $46,000, and then we look at a property that's inside this data point, and it might be $26,000. So it's going to severely impact the properties that we are looking for, and the business plan and the reposition that we can achieve in that property, because the income just isn't there if you're dealing with a $26,000 versus a $46,000 median household income. So you really want me to pinpoint the exact location of where you are in that neighborhood, inside that city, inside that MSA, and don't just take the broad strokes of data points like population growth or a median household income or a median contract rent, or some of the other ones are poverty level. You need to really get down to that granular level. Okay, so one of the other things we talk about is growth. Tell me something about growth when in terms of looking at markets.
Well, while it's possible to find success in any market, by picking a market that has growth, like whether it's population or income, the likelihood of a successful outcome is much higher. An analogy to this would be, if you're in a river and you're trying to row upstream, that would be akin to being in a market that's not growing, that's declining, or population, people are moving away. Whereas if you're not even rowing, you're just cruising down the stream, that is similar to being in a market where there's population growth, there's job growth, because you're just essentially riding the river. So examine the rates of growth for jobs, population, wage, rent, and occupancy.
Exactly. And one of our favorite, you already mentioned, city data is an excellent resource that we use almost daily. Other ones are BLS.gov, census.gov, are some of the other ones that we get these very important data points when it comes to growth. And one of the growth factors I look at, my metrics, I'm looking at my sheet now, is the 12-month or year-over-year percentage of growth. So if that has a market where maybe a 2 to 3%, I would say is pretty average for some of these markets that we're looking at, which is different than the markets where a lot of people are flooding to right now. A lot of the southern ones, a lot of the eastern Texas markets, or Florida or something like that, where their growth is going to be much higher. All right, so we're talking about assumptions now. So what is an assumption? What is like pro forma?
All right, so when you're verifying the sponsor's assumptions in the pro forma, which is the sponsor's projection of what the deal is going to look like, you want to make sure that these are based on historical data for that particular market. And you want to look at historical averages over the long term, not just that recent data. For instance, just because rent growth was high last year does not mean that it will be the same this year. Because past performance does not always translate to future success. So you want to be wary of overly optimistic rent growth assumptions and exit cap rates that are either the same or lower than the current market cap rates. And the longer the hold period is, the more conservative these assumptions should be. And you should put more weight on historical data. Because, for example, like in Dallas, in the last 5 years or so, it's been on fire. So pretty much all the operators did well because of the market, not necessarily because of their skills or business plan. Exactly.
It's the sea raises all the boats, or whatever that quote is. Or my favorite, the Mark Cuban, the everybody's a genius in a bull market. Yes, assumptions. And another thing to look for on that is look on not just the upside potential, but also, for me, I'm very conservative. I look on the downside risk as well when we're doing our risk analysis. So look at the historical data through past recessions. How well did this city, this neighborhood perform in 2008, 2009? How did it perform in 2001? How did it perform in 1987 through 89? All of these big recessions that we hit. And I'm sure in a couple of years from now, right now, this will be a data point. How did this property perform, or this city perform during the coronavirus pandemic? So you really want to see not just the upside of the historical, but also how resilient is this city, is this neighborhood? And there's many factors that go into this, which is one of the next points here is employment diversity. It's another one we look for because it adds resilience to the property and the business plan.
Yeah, so although job growth is important, the diversity of jobs is also important to analyze. And this is because if a submarket is too dependent on a specific industry, and that industry goes through a down cycle, then lay off a bunch of jobs, there could be a significant impact on the tenant's abilities to pay rent. So to hedge against this, you want to make sure that there's no single industry that makes up more than, say, 20% of the job market. You want to look at that pie chart and make sure there's a bunch of different slices of the pie that are different industries, and that will help to kind of insulate against these downturns.
Exactly, not just for the town, but also the sponsorship team usually does some level of this for the property as well. I know it's hard unless they have all the applications taking over, so sometimes they can get it, sometimes they can't. But knowing who the major players are in that town as far as jobs is very important. You said 20%, and then a lot of this is going to be in. You can find this in city data. Usually, simple Google searches. You can find top 10 employers in XYZ city, and you want to see what type of market share they have. Because the rule of thumb here is if you have a one-horse town and that horse dies, then the town dries up, right? It's and you see this a lot in some of those boom bust towns, anything around like fracking or the oil industry, where it takes OPEC one snap of a finger and dropping oil prices, and all the fracking facilities can barely operate, and they have to lay off hundreds of people. We saw it up in North Dakota and everything around the Minot area. So I think Pennsylvania also had a similar issue. So you want to make sure that the employment in that town is diverse. We try to target the 20% of that slice goes to any one sector or any one employer. All right, next one is absorption rate. Now, this one is, even for me, it's still hard to get like a pin down a number on what the absorption rate is. So can you walk us through that one?
Yeah, so the net absorption is defined as the change of the supply in the market over time. You measure this by subtracting the amount of supply coming on the market from the supply leased up by tenants. So this is really a measure of the amount of new inventory being added to the market net. So you want to avoid areas that are overbuilt with a bunch of new construction coming online, because this will lead to an oversupply in units. And if you don't have enough tenants, you don't have enough demand to absorb those, then that's going to lead to decreased rents and increased vacancies.
Yep. And some of the indicators, and what I meant this one being hard, is it's really hard to find accurate and current data. You know, for product being built, easiest way that I know how is just to go to the Chamber of Commerce for that town and figure out how many permits have been pulled and what stages of construction are they in. That way I can, and they can give that information to you. You can do a quick online search for that information. And you can figure out how many units are being brought to market. And then for the other side of it is the lease up of those. There's a couple things like the population increase. Are the people coming into that town more than the units being brought to market? And if it is, then that's a good sign. What's a bad sign is going and doing a quick Google search or apartments.com or something like that, and you're seeing brand new complexes offering concessions that are kind of not on par with what you would normally see in this market in this season. Like the middle of July offering, free month rent, move in, or no security deposits or something like that during like peak of rental season. So if you start seeing stuff like that, it might be somewhat of a not necessarily a red flag right away, but definitely something to take note of to investigate of why are these brand new complexes offering concessions? Because normally, if that's the case, then, and it's not just they just need to lease them up, they're in a lease up phase, but if they're having trouble leasing up the new units, that might be something to be wary of. Okay, so market cycle. So let's go into, everybody knows when we're dealing with money and credit, that creates a cycle. So let's talk about the market cycle.
So every real estate market goes through cycles, but not all uniformly or at the same time. Every one of the many metropolitan statistical areas, or MSAs, moves at its own rate, depending on a multitude of complex factors. So you kind of imagine like an analogy of like each MSA is like a car, and they're all kind of going at different rates. They have different tire sizes. They're different size cars. And it's not always just in a sinusoidal behavior where it just goes up and then down and then up. Sometimes it can reverse. Like there's certain trends that can lead to, like certain reversals of that movement. So you really want to study that particular submarket. And these are impossible to predict or even time. But if you have a solid business plan that's built on fundamentals, you should be able to weather any down cycles in that market. Exactly.
And for me, the best education I've ever gotten was actually not really real estate, but Ray Dalio. So Ray Dalio, I think he's a living, genius, in the securities market, hedge fund manager. You don't know, but he in his book Principles, but then also he has this outstanding video on YouTube. I think if you just search Ray Dalio, How an Economy Works, I think it's maybe 30 minutes, but I've watched that video probably 20 times because there's so much information, so many just like aha moments, and a lot of that can be applied to really any sector, any industry, and it's real estate as well. All right, now let's get into the fun part. So geoarbitrage, thing that we do, it's part of our business model, it's part of our company organization and how we do business. So let's talk about what geoarbitrage is and how you can use that to reach your goals.
All right, so Geoarbitrage is just a fancy name for the strategy where you invest where the metrics make the most sense. So the ones that we mentioned earlier, which is not necessarily where you live currently, or within an hour or two drive. And the nice thing is now that in 2020 we have all these technological advances like Zoom and so forth. So it's possible to invest remotely and still have a good grasp on what's happening at the asset level. And this is easiest to achieve by being a limited partner in syndication deals, since you can participate without having to physically visit the properties or do any of that physical due diligence. And I don't know, why don't you go over kind of how we do this at Tri-City?
Yeah, so a lot of people's markets are the barrier to entry is really high. Like you want to get into real estate, you want to invest, you get all excited, and then you go out, jump on like the MLS or talk to some brokers, and they start throwing prices at you, and you get like shell shocked or sticker shocked. Like I can't afford to, buy a property here. It's crazy. Like for us, we're in Hawaii. Honolulu's prices are insane. Most business models won't work, especially any cash flow business models are going to be very hard to work in a market like this. And I know some other capital markets, San Francisco or New York or something like that, where the cost to do business to those markets are just extremely high. So you have these either tier one markets or capital markets or whatever you want to call them. There's just a lot of equity sitting there, but not a lot of cash flow. So what you can do is leverage technology, leverage networks, leverage teams, leverage partnerships, and go to a location where the numbers make sense. And that's something we do. So we invest in the Midwest primarily. We have some stuff in Texas, some stuff in Michigan, because that's where the numbers make sense for us. And I feel completely comfortable with the teams we set up, the systems we set up in those markets, the people on the ground working with us there to run those properties and manage those assets. I feel very confident, mainly because of the technology we have and just the experience we have as asset managers and operators to be able to set those systems up. So being able to realize that, maybe where I live isn't the best market. I love living here. Hawaii is the best. But investing here may not make sense. To be able to partner with people and move to markets where it does make sense, where you get that cash flow and those returns you're looking for.
All right. So let's wrap this up. If you're interested in connecting with us, go to tricityequity.com to learn more. To connect with like-minded investors, join our Facebook group, Honolulu Multifamily and more. And if you found value in this podcast, please subscribe and give us a rating and review on Apple Podcasts or Stitcher. If you know anyone who might resonate with today's podcast, please share the episode with them. See you next time.
All right. See you, Duke.